Welcome everyone to today's webinar, Diversity as a Driver of Excellence in Your Investment Approach. I am Molly Gamble, Vice President Editorial for Becker's Healthcare. We'll begin today's webinar with a presentation, and we'll have time at the end of the hour of the presentation for a question and answer session. You can submit any questions you have throughout the webinar by typing them into the Q&A box you see on your screen. We're looking forward to hearing your questions. Today's session is being recorded and will be made available after the event. You can use the same link used to log into today's webinar to access that recording. We're excited to hear from today's panel. To get started, I'll turn the floor over to Mike Manning, Managing Partner with NEPC.
Great, thank you very much. We are really excited here at NEPC to be partnering with Becker to bring you this presentation on diversity as a driver of excellence in your investment approach. We currently work with almost 50 healthcare clients and over $100 billion in assets under advisement. So we feel like we've got a pretty good sense of the pulse of what's driving healthcare organization in today's environment. One of those is clearly diversity and creating an environment that is more representative of the communities that you all serve. And so we hope that today's presentation, whether you work in an investment-facing function or with the institution at large, we think there's a lot here that we can bring to bear. And we've been a leader in the investment aspect of working with diverse managers and bringing those to investment programs throughout our client base. So with me today, who will be speaking, you've got Sarah Samuels, who is the Director of our Investment Manager Research, Sam Austin, who's a member of our Executive Committee and also the Chair of our Diversity and Inclusion Board, Chenae Edwards, who is the co-chair of our Diversity, Equity, and Inclusion Network and also one of our healthcare consultants, as is Nina Petkova, who is also on the Diverse Manager Committee member. We're really going to focus on three things today, and those are: why should diversity be a consideration in your investment program? How can you influence your existing managers to promote diversity? And how do you set yourself up for success? So I'm going to bring Nina in to cover the first of those topics. Nina?
Thanks, Mike. Mike started off with this statement on why diversity is important to us at NEPC. Now I will go a little bit broader to why diversity should be a consideration in your investment approach. Let's begin the conversation by focusing on 4 key areas and highlighting some of the data and proof statements that support the case for diversity. Starting with performance, since the main focus for a lot of investors is performance. Contrary to some misconceptions, there is statistically significant evidence that diverse-owned firms do not perform any worse than their non-diverse-owned peers. This finding was part of a landmark study completed by the Knights Foundation in 2017 and updated last year with very similar conclusions. In an even more positive finding, a study completed by the National Association of Investment Companies found that diverse private equity funds outgained median performers in over 78% of the vintage years studied. At NEPC, we think it's logical to assume that portfolio management skill is relatively evenly distributed throughout the population, yet we see that diverse managers face challenges when it comes to attracting institutional investment capital and are often underrepresented in both numbers and even more so on assets under management basis. We also believe that allocations to diverse managers can be risk mitigating from both a performance and total business perspective. A McKinsey study found that companies with the most ethnically diverse executive teams are 33% more likely to outperform their peers on profitability, as measured by EBITDA. Not only that, but companies in the bottom or worst quartile on both gender and ethnic diversity are 29% more likely to underperform their industry peers. Omar Gatsby from Credit Suisse identified diversity as a risk mitigant in that it can reduce groupthink, one of the largest and most significant risks that an organization can face. We believe taken together, this indicates that investing in diversity could be a diversifier and therefore can help with risk mitigation in your portfolio. Next, let's look at stakeholder trends and peer trends. Those should be very important to healthcare organizations. I will walk through a few examples on how institutional investors and their beneficiaries have shifted their view. In the first example, it focuses on demographics, and more specifically, people of color are expected to become the majority of the American working class by the year 2032, which means majority of both hospital employees and patients will be people with diverse background. This estimate is based on long-term labor force projections from the Bureau of Labor Statistics and trends in college completion by race and ethnicity. The second example on the slide focuses on highlighting a behavioral preference. In a PwC study, 61% of younger workers said that they would actively seek out employers whose corporate social responsibility values, like diversity and inclusion, reflect their own. And lastly, we looked at the investment industry through our clients' lens. And about 40% of our clients already utilize diverse managers in their portfolios. This represents more than 100 institutional investors that control over 1 trillion of assets under management. Taken together, this means there's significant institutional interest in the diverse manager space, and that there's stakeholder and demographic tailwinds to growing that interest. We talked about the performance component of diversity and how, in addition to offering differentiated return potential, diverse manager exposure could help mitigate risk. We also talked about peer trend and stakeholder preference. And lastly, we wanted to highlight the regulatory focus in recent years. In 2018, the U.S. Securities and Exchange Commission created a voluntary survey to assess diversity policies and practices and encouraged firms to participate. A year later, the SEC announced the creation of the Asset Management Advisory Committee to provide the Commission with that diverse perspective on asset management. And then fast forward to this summer, the SEC has held a public virtual meeting where managers and advocacy organizations presented different recommendations on how the SEC could improve industry diversity and really making that topic a regulatory priority as well. We talked about the why, and I'm sure that many of you who had signed up for a webinar today are very familiar with that why conversation. Now we're going to turn our focus on the how. And I will let my colleague, Sam Austin, talk specifically about how to influence industry diversity.
Thank you so much, Nina. Nina did a great job of laying out what the advantages are of including diversity within the asset management portion of your program. Before I start talking, though, about how you can begin to influence that, let's make sure that we are very clear about the status of this problem in our industry. And let me clearly state that the problem is there is a significant gap in representation of women-owned and minority-owned firms in the asset management business from whom we can select as potential managers within our investment programs. Status of the industry is globally, there are about $90 trillion worth of assets under professional management. That being said, asset management firms owned or led by minority groups or women in the United States make up a much smaller percentage of that industry than would be expected by their representation in the population and their representation among total businesses run in the United States by minority and women firms. Nina mentioned earlier the Knight Foundation study, most recently updated in 2019, and we can see here some numbers representing women-owned firms as a percentage of various investment strategies. And just again to level set, women make up approximately 51% of the population in the United States. Women-owned businesses make up about 39% of all privately held firms, but only 10% of investment management firms managing mutual fund strategies are led by women. And we're talking about mutual funds here because it's very difficult to get your hands on clean data for institutionally managed strategies. So this study used data from Morningstar among mutual funds as a proxy for publicly traded equity and fixed income strategies. But only 10% of firms are managed by women. But look at the next big gap in representation. Although they represent 10% of the firms, women firms only represent less than 1% of the assets under management in the business. Similarly, with hedge funds and with private equity, women make up 5% of those firms running those strategies, but 2% and 3% respectively of the assets in those strategies. In real estate, women represent 2% of the firms and only 1% of the assets. Similarly, if we take a look at minority representation, minorities represent approximately 36% of the population in the United States. They represent about 15% of all privately held businesses in this country. But again, among publicly traded equity and fixed income strategies, 9% of the firms are minority owned. And only less than 0.5%, 0.4% of those mutual funds here used as the proxy for equities and fixed income are managed by minority firms. Hedge funds, 9% of the firms, 3% of the assets. Private equity is the one bright spot where the assets managed equal the percentage of firms that manage those strategies at 4% among minority firms, and the exact same percentages that we quoted a moment ago for women. Minority-owned businesses represent 2% of the firms managing real estate strategies and 1% of the assets in those strategies. And again, as Nina mentioned earlier, this gap exists despite the fact that there is no difference in performance by standard measures of statistical confidence as found in that Knight Foundation study. So we've talked about the fact that the major problem that we want to solve is that there is a gap in representation. Let's also talk about, are there some trends that may be exacerbating that gap? And here are two that we believe may be having a negative effect. One is that increased regulation in the form of reporting requirements, compliance requirements, that those duties are much easier handled by large firms that have a big back office. Smaller and newer firms tend to have, that's more of a burden on them. In addition, a longer-term trend in our business of fee compression among investment managers tends to be, again, a higher amount of impact on smaller firms that have not necessarily reached their scale that they need to in order to be able to grow their business. Okay, now that we've talked about the problem being stated clearly and what trends are affecting that problem, let's talk about what can we begin doing to close the gap that we talked about. One positive trend that we've seen, and we've acted on at NEPC, but I think this is a broader trend, is that instead of approaching diversity in our business as a check-the-box issue that can be solved by a one-size-fits-all strategy or a one-dimensional approach, of trying to find a way to shoehorn in an additional chair at an already crowded table. You'll see that represented by the green chair on this graphic. We believe the approach that's being increasingly used throughout the industry, and we've chosen to follow this as well at NEPC, is to look for multidimensional ways to expand the table, allowing for more chairs to be seated there. So let's take a look at what some of those pathways are that you might want to consider. I said we would level set the industry. Let's also level set the status of diversity among the registrants for today's webinar. I believe around 23% of you who registered today indicated that you've not yet gotten started. By being here for this webinar, that indicates you're interested in getting started. So that's fantastic news. About 55% of you say that you've made some beginnings, but kind of in the beginning phases of it. You're not yet advanced in integrating diversity into your investment programs, and only about 19 or 20% indicated that you were already advanced in this particular dimension. So what are some of the pathways you consider if you can't go from 0 miles per hour to 60 miles per hour overnight? What can you do right now? One really straightforward thing to do is an open door policy. And at first glance, that might You might think that has a big cost to you as investment staff if you happen to work in the investment portion of your organization, because an open door policy might mean you're getting a lot of calls or visits from diverse managers. But an easy way around this is that if you do have an investment consultant, to insist to your consultant that you want them to have an open door policy representing you. That's a great way to make sure that you are seeing talented, diverse managers and having an opportunity to include them in your programs. The next level of sophistication is to actually begin a conscious inclusion of diverse managers in the search process for any given search that you might be having. So for instance, if you are having a broad search for an international equity manager, you're not necessarily specifying that it's for a diverse manager in that space, but you'd want to be consciously aware that you not write the requirements for that search so high that you're excluding diverse firms. For instance, if it was a developed international equity manager and you indicated that you would only accept firms that had a minimum of $50 billion of assets under management, you would likely exclude just about every woman-owned or minority-owned firm in that space. So that's a next step of sophistication and a different pathway to pursue. The most formal way of approaching this is to actually create a diverse or emerging manager program. And my colleague, Chenae Edwards, will talk about that in a moment. But that would actually entail writing in some specifications into your investment policy statement, creating a decision of whether you're going to have your own investment staff identify and hire and maintain relationships with the managers that you choose, or if you were going to work with a fund of funds or manager of managers, again, which Chenae will talk about, that could do that for you. There are many other gradations, but we thought these three pathways would give you an idea of some of the multidimensional approaches that are available to you. What can you do right now? Again, you might not be able to jump immediately to starting a diverse and emerging manager program, but right now, one of the things you can do is to promote the need for a diversity and inclusion strategy throughout your own organization. And I'm quite sure that most of you on this call already have a diversity and inclusion policy as part of your organization-wide commitment to this effort. And you'd want to make sure that you are making sure that the diversity in your investment program is true to that larger commitment to diversity throughout the organization. And again, Chenae in just a moment will talk about that in more depth. Secondly, before you even think about perhaps hiring new diverse managers, is there something you can do with your existing set of managers if you don't happen to have any diverse-owned or diverse-led managers in your lineup? You can certainly communicate to those existing managers that diversity is a priority for your organization. How can you do that? Almost certainly you have an annual or regular due diligence process of checking on how your managers are doing and are they maintaining authenticity to their investment process. As you do that, either in verbal questioning when they visit you or via Zoom these days, or through sending out a due diligence questionnaire, you can make sure that there are some specific pointed questions that you ask those managers in terms of what are they doing to promote diversity within their portfolio management team, if they're a publicly traded company, diversity on their board, what are they doing to develop diversity internally? Believe me, as soon as you begin asking those questions, your managers also understand it's important to you and it's likely to drive action on their part. And then thirdly, you can plug into industry resources that have already plowed the ground ahead of you. They've already developed a set of best practices that you can share in, and they can give you input on finding and potentially hiring investment talent onto your staff from a diverse background. So let's take a look at first the partnership side of this equation on the right-hand side of this page. Organizations that you can partner with include the Diverse Asset Managers Initiative. It's an advocacy group that lobbies for the industry to become more diverse, and they actually send out a survey every year to consultants like us, having to explain exactly what we're doing in our own organization from a demographic perspective, as well as what we're doing to make sure that we're properly vetting diverse firms in the investment management space. You can also partner with one of the organizations that represent various underrepresented groups. The Women Investment Professionals Organization, the New America Alliance, which historically has worked with Latinx investment managers, the National Association of Securities Professionals, which has historically worked with African American businesses in this space, and the Association of Asian American Investment Managers. These are three groups that you may find very helpful in finding talent that you may want to consider in your portfolio. And then finally, the National Association of Investment Companies, which is a broad group that represents women and minorities-owned businesses in the private equity and private real estate and private infrastructure space. On the left-hand side of this chart, there are also organizations that develop and target interns that may be hired by organizations like your organization or ours at NEPC. The Girl Scouts, Girls Who Invest, the TWIGO organization, which focuses primarily on diverse MBA students interested in careers in asset management, the SEO, or Sponsors for Educational Opportunity organization, which has the same mission, only with undergraduate students instead of MBA students, and the Fund 2 Foundation. All of these are sources of potential talent that you may want to consider within your own investment organization. So with that, let me hand it off to Chenae Edwards, and my colleague will tell you a little bit more specifically about how to set yourself up for success in integrating diversity into your investment program. Chenae?
Thank you, Sam. Hello, everyone. I am Chenae Edwards, and I want to spend some time highlighting how you can set your organization up for success. I'll start on a strategic level and focus in on some of the strategic frameworks that you may find helpful. And then I'll dive a little bit more deeply and look at some tactical application and techniques that will help your organization. So first, Sam introduced this idea of a diversity and inclusion strategy earlier. This is one of the key components of our first predictor of success, authenticity. And a diversity and inclusion strategy will really ground you in your organization's ethos. What are the things that your healthcare system truly values? And many of you already have these strategies. So now it's more of focusing on how your investment portfolio aligns with this strategy. If you don't have one, it's okay. Many organizations are now working on creating one, and there are several resources that are publicly available that you can find helpful. But it's important as it relates to this strategy to align the values of your organization from a firm and employee perspective, but also with an eye towards the communities that you serve. The last piece of kind of fostering this element of authenticity is really integrating this diversity and inclusion strategy throughout your organization. People will look and see that this strategy is real and something that you mean to support for the long term. As we flip through, I wanted to share a framework for those of you who may be working through your diversity and inclusion strategy to really help you lay out all the pieces and put them together. So this framework was developed by experts at Cornell University, and you'll see from the top header that it starts by looking at your organization's values. And your values really influence your diversity and inclusion business case or the strategy. And there are a few main cogs or wheels to this diversity and inclusion strategy that you should keep in mind. Workforce, workplace, and marketplace. We'll spend a lot of time looking at marketplace because this is how you integrate your investment portfolio with your overall strategy. But let me just spend some time and just provide a high-level overview of workforce and workplace. So the workforce component really looks at your employee demographics. And you've probably already heard about this part of your strategy if you're targeting different underrepresented groups within your system. It could be women, it could be different underrepresented racial or ethnic groups. The workplace component really underscores or highlights the policies and programs that you implement to create an inclusive organization. And marketplace centers around the vendors, the key stakeholders, and suppliers for your organization. So you see how the investment portfolio fits nicely under the marketplace piece. Now that you have a framework, I want to turn to another predictor of success that your organization needs to keep an eye towards. This one is really focusing on integration of design. So how your organization really designs this promotion of diversity throughout its investment program. The integration design phase has three key parts. The first centers around being intentional about your goals. As you think about your goals, they'll really drive how you want to proceed. For example, identifying your primary goal. Are you seeking to improve return in your investment portfolio? Are you seeking to identify a new and undifferentiated source of alpha? Are you seeking to provide more diversification or risk mitigation? This will help you determine what target you need to go after as it relates to the type of manager and maybe the universe of managers. And once you outline your goal, this will also help you determine what metrics that you need to have in place really to measure results over the long term. Sam talked about it earlier. As you look at your annual due diligence process that you run with all your investment managers, you may need to add more metrics within this process to account for diversity. And that comes to shape as you think about the design integration component. The next piece is really aligning the structure with your DNA. So aligning how you're building out this promotion of diversity within your investment program with how you're already managing your investment assets. You may be thinking, what do we need to do to really achieve these goals? Are we targeting existing managers, or are we focused on identifying new managers and expanding the managers in our portfolio? Do we want to create a diverse manager program? Whatever structure that you decide to move forward with, there are different elements of structure that you will need to do to make sure that you can have a sustainable implementation over the long term. And I'll give you an example thinking about promoting diversity with existing managers. So to Sam's point earlier, you may want to just send, if you've already had your annual meeting with managers, send a quick note and say that we are focused on promoting diversity over the next few years with our investment program. And what that means is we want our long-term partners, like our investment managers, to do the same. And so outline what you're trying to do internally, suggest what you would also like to see with your investment managers, and give them some metrics that you will be following up with on an annual basis so they can understand that these are the new set of expectations that you're looking for longer term. So that's one example. Moving to the last element of the integration of design, this is really rooted in assigning responsibility for oversight. As many organizations, there are definitely several people that have an oversight role within the investment process. On a day-to-day basis, it may be your internal investment staff that are monitoring the managers, your investment committees may be involved on a quarterly basis looking at kind of your long-term goals, but you really want to understand what resources you have to really oversee the program and what skill sets or gaps you may have and how you can fill those gaps with external resources. So we listed Sam talked about a few organizations. So if you realize that maybe I don't have a network that extends itself into some of the areas where we want to increase the number of diverse managers, how do you grow that network? How do you participate in different conferences that you may maybe don't even know exist? And you may be able to bring in different investment consultants, partner with different advocacy groups, or use your existing networks of other healthcare systems that may be trying to achieve similar goals. And so really thinking about who is responsible and do you have the right players at the table to help you move forward with this level of design integration. While we believe that there are many predictors of success, and we've talked about a couple of them here, we also believe that there are some predictors of failure that we want you to stay away from. And all of these kind of fall under the umbrella of poor planning. The first one centers around the doom loop. And you may not have heard about this, but I am sure you probably have been in a room where this may have happened before. And it's termed by John Rice, the founder and CEO of Management Leadership for Tomorrow. But it's really defined as the failure to define success, because discussions about goals in the context of race and gender tend to be uncomfortable conversations, or in some cases perceived as legally risky to have. And even in some cases, some people may feel that if you even put on the floor goals as it relates to this context, that you may be talking about quotas. And that's definitely not what we're trying to do, but I will say that the doom loop is one thing that can stand in the way of progress as it relates to achieving your diversity goals. Another thing that we want you to avoid or recommend avoiding is the let's do better than last year strategy. It's really not putting a stake in the ground. It's not taking a position. It's just saying that I know we can do something. And it kind of lends itself to saying it's a check the box exercise and can erode the authenticity of any strategy that you're trying to implement. And lastly, random acts of diversity. While these can be very well-intentioned, sometimes they lead to unintended outcomes. Typically, what I've seen is something happens and you have some early wins and everyone gets excited, but because there's no clear strategy, the sustainability of implementing any improvement in diversity is very short-lived. And so any of these three items can definitely lead to what we would say are predictors of failure, and we want you to definitely avoid them. So I've talked about successes, predictors of success, and predictors of failure. I want to just introduce another framework that I think will be quite helpful as you think about working in what may be a very consensus-driven investment structure within your organization. So think about this as something you can do right now differently tomorrow. There's a step here for everyone. And the first step that some of you may take in, given the information that you shared of where you are today, some of you may just be learning. You may be having discussions with your investment committee, and you may be learning at a staff level. If you're there, that's fine. The next step in this framework centers around building consensus. So looking at who are your key stakeholders, who do you need to bring to the table? It may be your board, it may be some external community members, it may be some advocacy groups to help you understand how to get to the next level. And then really centered around, once you've identified where you are and where you want to go, how do you memorialize this? Update it and include it in your investment policy statement, and really evaluate yourself on a consistent basis. Next, focusing in on how do you engage and actually make tangible results. Working with your investment consultants, working with your internal staff, working with these different advocacy organizations to really move the needle and drive progress within your organization. And lastly, you want to iterate and share, and I don't want to push past this quickly because I think this is a very important point. A lot of times you lend a lot of credibility and authenticity to your program by being able to share internally what you're doing, and also if it's possible, sharing externally. You may also get a lot of unsolicited ideas about ways that you can move the needle and continue to have progress by sharing. So this framework, I definitely want to give credit where it's due. It was developed by the Intentional Endowment Network and released earlier this year. And it's one that I think some of you will find quite useful. Now, we've talked about a lot of strategic items. I want to move more tactically because we've introduced this idea of a diverse manager program. And so I think how you can establish a diverse manager program may be a question that some of you are thinking about. And so I'll dive in closing into this topic a little bit more deeply. And I'll try to break it into a few bite-sized pieces, but also provide examples so you can think how this may apply to your organization. So for starters, really you're focused on defining success. So for example, your organization may say, we want to have a goal. We want to have a goal of having 10% of our assets invested with diverse managers, however you define diverse, and we think we can achieve that goal over the next 3 years. Note, I included an actual numerical goal in addition to a time frame. So you would think about defining success how you would in any other aspect of your organization. When you have a strategic plan, you define success as it relates to a target number, you want to quantify it, and you set a realistic time frame for reaching that target. Secondly, you want to identify resources. So you may need to say, hey, we may only have a few individuals on our staff. We may need to bring in other resources. How do you identify those resources and those gaps and introduce those people? So staying with the same 10% example, you may say, I actually look at our baseline and historical numbers, and we haven't been talking to diverse managers. How can we ensure that our pipeline is inviting more managers to the table in terms of the meetings that we take every year or the meetings that our consultant takes every year? And so identifying tangible resources so you can meet your goals. The third step is really determining what metrics do you need to evaluate results. So we talked about the 10% top line goal, but it isn't really enough to get to that goal only without having some mini goals beneath that. So as I mentioned, you say, we're not even meeting with diverse managers. How do we even uncover them? So maybe having a goal of meeting in year one with 10, 20% more diverse managers, 10 diverse managers per year, whatever those targets are. So you set yourself up with mini goals to help you really achieve your long-term goals. And lastly, similar to what I said in the other framework, is really establishing action-oriented guidelines. You want to memorialize whatever your big picture goals are within your investment policy statement so you can really measure yourself and show progress over the long term. And in this policy statement, you may have any other definitional things, as in how do you define diversity or what size of firms you're looking for, and so on and so forth for the program. So thinking about implementing a diverse manager program, there are many different ways to do it. I will say you can focus on only one asset class, looking at only international developed equity, particularly active strategies. You can even say, well, we have a lot of passive exposure in our portfolio. We only want to look at passive strategies. Or you can take an approach where you want to do it across the whole portfolio. But I'll give you some examples of some programs that we know have been successful and many people use. So one is a direct program, investing directly in investment managers, just like you would any of the other standard investment managers in your program. But this will require you being able to do the research, diligence them in the same way. The other is a manager of manager program. So essentially you invest with one centralized firm or investment manager, and they invest in many underlying strategies. So sort of like a fund-to-fund type of structure. And then another way to do this is a graduation program. Many organizations have done that in the past. Hey, we have a diverse manager that we want to invest in. We would allocate maybe a somewhat smaller allocation than is for our standard allocation allow this manager to build a track record of success with our organization, and we graduate them up to a larger size. There's many different ways to do graduation programs, but this is just one example. And then customized programs can be a combination of any of these or something that just works uniquely for your organization. So as I conclude, I do want to give you a few common mistakes that may get in the way of a successful program. And I'll walk through these pretty quickly. Having a check the box exercise is not going to get you there. And so we definitely want you to avoid that. Then ensuring that there is buy-in across all key stakeholders. Without this buy-in up front, you run the risk of having less authenticity and longevity for your goals. Also, not having a thoughtful framework will create challenges as you walk through the process. And lastly, don't get lost in the data. People like to call this analysis paralysis. It is important if you have a goal to get through the data, but also find a way to take action and move forward. We know that there's imperfect data out there, and there's a lot of tools that can help you get through all the data on diverse managers in this space. So now I've talked to you about how you can set your organization up for success in a strategic, but also in some very tactical ways. My colleague, Sarah, will come and talk about NEPC as a case study.
Great. Thank you so much, Chenae. Hi, everyone. I'm Sarah Samuels. I'm a partner at NEPC, and I oversee our investment manager research team. My colleagues just went through the reasons why diversity improves the bottom line and the work that remains to be done as an industry. And what I'm going to do today is highlight as a case study what we're doing at NEPC to improve the representation of talented, diverse managers in institutional portfolios. So we're doing three main things. Internally, we have major initiatives to promote diversity within our organization, within NEPC. Second, we've set a diverse manager policy to ensure our own accountability in this area. And third, we are taking discrete steps to engage with diverse managers. So this is what I'm going to talk about today is an example of what we are doing at NEPC as a case study. And a couple of these things might be areas that you could also use as well. So a couple of examples that some of my colleagues already talked about, attend industry conferences. There's a lot of resources available out there if you know where to look. Be proactive about getting involved with groups that are dedicated to this effort. So for example, in my personal time, I'm very involved with Girls Who Invest, and I co-founded the Private Equity Women Investor Network, the Boston chapter. My colleagues are also involved in several of these types of groups in the industry to promote diversity. This is great because being involved in such industry groups not only many times can fulfill a personal passion, but it also helps to expand your organization's network and your knowledge of diverse managers. If you use a proprietary database, you can begin to track diverse managers internally at your organization. If you use a third-party data provider, we're excited to share that NEPC and the consulting community at large are working together with eVestment, which is a third-party data provider of investment managers, to dramatically upgrade the quality of information that eVestment collects for these diverse managers. And then the last piece of action that we recommend is setting targets for yourself to come up with a plan to meet the mission and the objectives that you've set for yourself. So we'll talk a little bit about how NEPC has been doing this. What we've laid out here is NEPC's diverse manager policy. So this is one of those three pillars that I talked about that NEPC has focused on to help advance our diversity efforts. We have a 35-person investment manager research team at NEPC, and we realized that if we want to be successful in our diverse manager efforts, we really need to set tangible goals for ourselves and for our team members. So first, so you can see on the top left part of this page, we're targeting that 10% of our highest rated, our most highest conviction strategies be diverse firms by the end of 2021. And Sam showed you this graphic earlier. This is sort of an example of increasing the table size. So that there's more room at the table for diverse managers rather than trying to squeeze in diverse managers into an existing manager footprint. Second, the next metric that we're holding ourselves accountable to is that we're targeting a 10% increase in meetings that we take with diverse managers by the end of 2020. So these are in our team members' goals and objectives for the year. They're each going to be reviewed on the progress that they make. So this is really incorporated organically into the mission of the team and the direction that we know we need to go in. And then third, we're going to make best efforts to include diverse managers in client searches when an appropriate manager is available. So this really means that we are increasing the odds and the access for diverse managers to be looked at, to be considered, by ensuring that we have a diverse manager in a client search. So there are a number of ways that we engage with diverse firms. I won't go through everything on this page in the interest of time, but one thing that I would like to highlight is that, one of the things that you will likely need to do is to determine what it is how you are defining diversity. Some organizations focus only on the ownership of a firm, so whether an organization has greater than 50% diverse ownership. We look at that, but we also look at, whether there's substantial diversity across the firm. And so we're really looking for leadership within the diverse managers. So this slide here talks about how we are sourcing diverse firms. I won't go through everything on this page, but I think one area where all of you could really make significant progress is talking with your peers. This is an excellent space to share ideas and an excellent way to collaborate and help one another identify great diverse firms out there. The power of your network is really important. At NEPC, some other things that we've done to improve, and increase the scope of our lens when looking at investment managers is client referrals. So there are a number of clients that we have that are actually beginning to push ideas to us, whereas historically it's been a one-way street and we've pushed ideas to clients. This is really exciting because I think what this means is that the importance of diversity within our client base is becoming more important. And we're beginning to see this two-way line of communication between clients and ourselves. We are also looking at public RFPs. So public funds have also embraced this idea that diversity matters, and they issue RFPs, and that's a great way to source and get a great list of firms that are out there. And then we maintain our own database, which is something that you all might consider doing, or you might want to use eVestment as an external database. So in closing, these are just some examples of what we do. A couple of these things that could be useful to you would be attending industry conferences, beginning to track your exposure to diverse firms and the diverse managers that are out there, and setting targets for yourself to come up with a plan to meet those targets with and including a way to measure success. So with that, I'll turn it over to Nina.
Thank you, Sarah. We hope that this has been informative and helpful as you're all progressing on your own authentic path towards including diversity in your investment approach. As a firm, we believe that diversity can be a driver of excellence in your program in the same way that it has been a source of richness in our community. Now we would like to open the floor for some of your questions. And I also want to inform everyone that you will have access to the full presentation deck after the webinar.
Okay, thanks, Nina, for teeing us up on the question and answer portion of the webinar today. So attendees, we will begin that portion of our presentation. You can submit any questions you have by typing them into the Q&A box you see there on your dashboard. And we'll try and get through as many of these questions as we have time for. I also just want to thank today's speakers for that fantastic presentation so far. We have had some questions roll in, speakers, one being, what steps would I need to take to assess current exposure to diverse managers, and how would that compare to industry peers based on what you're seeing? Nina, can I throw that to you, and perhaps you can steer it along to whichever colleague you see fit to speak to it first?
Thank you, Molly. I think Chenae Edwards will address this question.
Yes, thanks, Nina. Hi, everyone. So I think the simplest thing to do for many of you would be able to fully understand where you are today is to create a baseline. So understand with your definition of diversity, how many diverse managers that you have in your portfolio. So it may be from a women or racial ethnic perspective as you look through your portfolio. I think today, unfortunately, there is no hard and fast peer benchmarker universe, but there is starting to be more studies and more data. And one that we think that would be helpful for many of your organizations, particularly if you are not-for-profit organizations, is data published by the Knight Foundation. So earlier last year, they did a diversity of asset managers in philanthropy report. And in that report, they essentially said that on average, about 13% of assets managed by the top 50 foundations or endowed assets were with diverse managers. So about a 13% could be a baseline for kind of the mega large endowed investment pools. But I think starting with the baseline for your organization is key, and understanding what peers where they are would be a second component.
Okay, thank you, Chenae. The next question we have from an attendee is, what is an example of a diverse firm where the diverse status is key to their investment thesis and or is providing the firm a differentiated access?
Great. I'm happy to take that question from the investment manager research perspective. We underwrote a couple of years ago a really interesting strategy that is a good example of this. It is a strategy that invests in structured credit. And it's a private credit fund. And the reason that this strategy was so interesting is because it's a great example of how the manager's diverse status was a key component of our investment thesis and their investment edge. This was an example where this manager had access to exclusive auctions through Fannie and Freddie, community impact pools that were issued by Fannie and Freddie. The fact that this firm had MWBE status meant that they were able to engage and participate in these pools of offerings, something that's not available to non-diverse firms. This is a requirement that's set forth by the FHFA regulatory mandate. And so the ability of this firm that we recommended to our clients, the ability of this firm to engage in these less competitive auctions meant that they had a significant edge and were able to add several percentage points to their expected return relative to their peers who are not diverse.
Terrific. Thank you, Sarah. Well, you know what? I believe we have come up against our time or close to it, and given the questions we have, you know what? There is actually one more that came through here. Pardon me. Okay, let me make sure we get to this question too. We do have time for it. So Nina, I will pose this one to you again, and you can steer along to the colleague you think is best positioned to speak to it. But the question is, there's no moving the needle on healthcare inequity without aligning diversity and inclusion with addressing social determinants of health. What are your thoughts on potential best practices for such an agenda?
This is Sam Austin. I'll take a try at that.
Oh, go ahead, Sam.
Sure. And Chenae, please feel free to jump in if you have more detailed information. I was going to refer to something that Chenae said a little earlier, which is that one of the key components of successfully integrating diversity in your investment program is authenticity and tying in the investment aspect of diversity to how your organization views diversity as a whole. So certainly being able to answer that question is probably something that's more in the purview of Nina and Chenae, who work in our healthcare or consulting operation. But we do this across the board with all of our types of clients, of trying to help them marry what they're trying to do here with the social constructs and the environment in which they operate. Chenae, would you like to expand on that?
Sure, yeah. So some of the social determinants of health may be gender inequality, maybe income inequality, and the likes. And I think to Sam's point, it really is, you should really focus on what key elements of those social determinants that your organization is already focused on and probably already has initiatives in place to alleviate. And so as you think about your strategies, there are opportunities to invest in more thematically oriented strategies, mostly in the private side, but also in public market side as well. So there may be strategies that seek to combat income inequality or gender inequality. And I think it is, as you get kind of down the path of saying these are the determinants of health that we can link with our diversity and inclusion strategy, then we know which types of investment managers that we can target to align with this strategy.
Okay, thank you, Chenae and Sam. So panelists, I just want to thank you again. This is Molly, for all of your remarks today. Mike, Sarah, Sam, Chenae, and Nina, you shared an excellent presentation and slides. And I'd like to thank NEPC for sponsoring today's webinar. Before we wrap up, are there any final thoughts or remarks from the panelists we can feature before we conclude? Okay, well, I think you said it all in this past hour, so thank you again. And attendees, this is all the time we have for today. I hope you enjoy the rest of your day on behalf of Becker's. We look forward to having you join us for future webinars. Thank you very much.